thank you for taking the time today to attend this webinar, How to Save Your Investment Portfolio's Life. Let me start with a question. How would you feel if your $100,000 portfolio in a matter of months went down to $70,000, $60,000, or your $1 million portfolio declines $300,000? Some investors would regret not taking action. Other investors would say that's just the way it is. You have to endure the decline so that you can participate in the rallies. Many investors would like an alternative. Another way of investing in the stock market without having to risk your family's financial lives going through these terrible declines. That's what I'm here to offer in this webinar. Not traditional, conventional investment wisdom that takes investors on these terrible declines, but a strategy and thinking that appeals to investors at a higher frequency, and that frequency is common sense. So to summarize the message of this webinar, investors face two distinct paths today at the tail end of a stock market bubble. Pathway one is the pathway that most investors will follow. Be a victim when the stock market bubble pops. Pathway two, seize an opportunity of a lifetime. Investors have an opportunity of a lifetime where they can lock in gains from one of the largest stock bull markets in history and then be ready for the next cycle with strategies that are ready whatever comes next. A continuation of the bull market, a sideways market, or a declining market. There are all sorts of barriers that will stop most investors from seizing this opportunity. People are smart, but they're also busy. Between being busy and indecision, it leads to inaction. Inaction now could impair your investment portfolio for years or decades to come. This webinar is for any stock market investor who cares about their family. Specifically, the webinar is for individual investors, 401k investors, pension and profit sharing plans, charitable foundations, and investors concerned about taxes. Attendees will be exposed to the strategies and thinking of successful millionaire and billionaire investors, critical to navigating today's dangerous financial market environment. We are in another stock market bubble, just as big and massive as the tech bubble from the 1990s. Back then the bubble was confined to one sector and the US government fiscal budget was producing surpluses. Now the bubble has artificially inflated the entire US stock market, and that stands on top of record US debt. The stakes and risks are as high as ever. Those that take no action during this impending crisis are putting their portfolios at risk, as well as the future of their family. Like the last bubble, most investors won't take action, or when they do, it's too late. Inaction stems from busy lives. Investors are smart, but we all have second-rate conventional wisdom that has been beaten into us over the years, which holds investors back. Brief background here. Talking in terms of quadrant 1 and quadrant 3 activities, a quadrant 1 goal or activity is something that is right in front of us on the current horizon, like the current stock market rally. Quadrant 2 activities are planning for future events with the current horizon in mind. For example, planning for your retirement and assuming the stock market rally will either continue or it will always produce positive returns. Investors, whether they are pension plans or everyday investors, have busy lives and are hampered by conventional investment wisdom. So their activities are mostly confined to quadrant 1 and quadrant 2. Whether it is investing or business, the real money to be made is by successful investors in quadrant 3 activities, looking beyond the current horizon, or in other words, preparing for the next cycle and when things change. Quadrant 3 involves discussing and preparing for events that are not on the radar of most investors, while successful investors many times have been preparing for quadrant 3 events for years. So this webinar is about getting investors aware and ready for the quadrant 3 events where the stock market and or bond market bubbles pop and what to do about it. Let's look at what happened after the largest bull market ended, which was also when the tech bubble from the 1990s popped. The largest stock bull market in history was from the 1987 to 2000 period. After a huge run, what happened next was a huge bear market decline of negative 49%. History and common sense tells us that something different happens after a run-up. A decline happens. Not only are the declines violent, but they happen quickly. Within a year of the NASDAQ bubble popping, it was down 40%. Also, everything was different after the NASDAQ bubble popped. Leadership completely changed from tech stocks to old economy stocks, from large cap stocks to small and mid cap stocks, from US stocks to international stocks. So a key lesson is that what works in one cycle may not work in the next. Index investing is a great example of this. During a raging bull market, of course, indexing is going to do well. But when there is a declining market, it's disaster because no one is flying the plane. I respect and understand the shift to index investing by individual investors, pension plans, and 401k offerings. We use index funds too. But this shift is setting up a huge disaster if there is a big bear market. Investors will see their gains disappear sitting in passive investments during a bear market. What worked during the bull won't work in a bear. There seems to be a lack of urgency among index investors. I don't feel index investors are asking themselves what happens next when the bull market is over. I don't think they realize how exposed they are. Part of the problem is that indexing has been co-opted by bad conventional wisdom such as strategic asset allocation, which says stay in the market all the time. The true benefit of indexing lies in its average returns, low costs, and tax efficiency. It is not meant to be a guide for asset allocation, telling investors to stay invested all the time. That is a reach that co-opts indexing into something that it is not, and makes things dangerous for investors using it that way. I respect that many index investors are true believers. I believe in its core tenets of average returns, low costs, and tax efficiency too. But where index investors are putting themselves in extreme danger is being true believers in the bad conventional wisdom that has co-opted indexing, like keeping a permanent stock allocation and buy and hold investing. Will a 30 or 40% decline in their portfolio make them rethink their convictions? I don't try to convince them out of it. Our winner strategy, which I'll discuss shortly, just gives them a better solution, which is the best of both worlds. They get to continue using index funds on the upside and then get major protection on the downside. Currently, index investors are getting no protection with a permanent stock allocation. The last point I'll make is that most successful investors don't think this way. They are not permanently invested in the stock market. Even Warren Buffett keeps large cash allocations when he thinks stocks are overvalued. Great investors are constantly vigilant about being wrong and what's going to happen in the next cycle. Index investors now are full-on invested and betting on stocks to go higher, even at the top of an artificially inflated stock market bubble. No one should be more vigilant and concerned about the dangers about the other side of indexing than the 401k investor, whose investment options have transitioned dramatically to index funds within their 401k plans over the past few years. I'll discuss the 401k investor shortly. One of the most widely used conventional wisdom strategies, if you can call it that, is strategic asset allocation. I've referenced it a few times, so let me explain what I'm talking about. Strategic asset allocation sets up a near permanent, always-on asset allocation, say 7% stocks and 30% bonds. The stock portfolio is then divided up into narrow style boxes in the name of diversification. Then strategic asset allocation periodically rebalances the asset allocation back to 70% stocks by selling winners and buying more losers. Most investors would hear that and say, what's wrong with that? We have all been indoctrinated into this way of thinking at some point during our investment lives. I won't discuss all the reasons strategic asset allocation is not a good plan for investors, but mention the ones that are most relevant to today. The most important reasons why investors should stay away from strategic asset allocation today have to do with protection. It doesn't protect investors during bear market declines like 2008, as its 2008 returns show here. Secondly, strategic asset allocation is made up of primarily two asset classes that are both in bubbles, ready to burst anytime: the stock market bubble and the bond market bubble. So here's some terrible rides that the stock market went on during the previous bear market. And they're great examples of where strategic asset allocation and conventional investment wisdom let us down. Conventional wisdom would say you have to stay invested in the stock market at all times so you don't miss the rallies. That means 30%, 40%, 50% declines sometimes in your portfolio along the way. Common sense says that's too severe. Our strategy's goal is to smooth the ride for investors, with the goal of giving up some upside return for removing far more downside risk. Most conventional wisdom strategies can only make money in up markets. Winner strategy gives investors the chance, but certainly no guarantee, to make money in both up and down markets. It offers far more protection during a bear market than indexing and strategic asset allocation. The 8-year process building Winner strategy concluded with its 2017 launch. 2008 was the impetus to build Winner strategy. Our client portfolios did far better than the general markets, which were down 37% in 2008. But we still had negative returns, and as a tactical investment manager, I was deeply disappointed with that. There were major opportunities in 2008 in commodities, treasuries, and shorting the market. We did not take advantage of these opportunities and began the process to build an investment strategy that had a chance to earn positive returns even during years like 2008, as well as participate in market returns on the upside. Winner strategy uses exchange-traded funds and mutual funds. It's a go-anywhere mandate, and its allocation can move anywhere from 0% invested to 100% invested. This could be in stocks, bonds, commodities, currencies, as well as shorting any of those major markets. Some years like 2012, the asset allocation hardly changes. In other years of major transition, the allocation could change on a monthly basis. What sets it apart from conventional wisdom strategies is its focus on downside protection. It has an elaborate sell process that aims to keep losses tight and let winners run. Here's some sample back-tested returns for Winner strategy. The years shown are worst-case scenarios so far, either the toughest market conditions or years where the strategy did not do as well, so you can see what worst case has been. 2008 shows Winner protecting portfolios. 2009 shows Winner slightly trailing the market, but still delivering strong positive returns. 2011 and 2015 are examples of volatile years where Winner strategy doesn't do well. Even when Winner doesn't do well, we are going to serious lengths to keep losses small. So Winner strategy has its weaknesses like any other strategy. There is a trade-off for all this downside protection. It may trail on the upside during up markets, but overall, it accomplishes the goal of giving a chance for positive returns in up and down markets, and it offers major downside protection that conventional strategies do not. So let's look at a real-life scenario and how Winner strategy acted during the large market declines that started February 2nd, 2018. Winner strategy was fully invested with no changes to its portfolio during the month of January, gaining over 6% for the month. Then in February, Winner strategy, like the rest of the market, takes its hits starting on Friday, February 2nd. But unlike most strategies, it has precise sell conditions, causing it to fully sell out of all stock positions on Tuesday, February 6th. Winner strategy was down 6%, giving back January gains but staying slightly positive year to date. Winner strategy then avoids the negative returns that happened Wednesday and Thursday. Winner strategy, based on February market action, did not move back into stocks for the rest of the month. In the short term, the worst case scenario is that it can miss a rally in the second half of February. At the end of the month, the strategy reevaluates if it should go back into the market. And here's the major distinction. Winner strategy moves quickly to stop capital losses. It trades away further negative returns for the loss of an opportunity by being out of the market. By being out of the market, the worst case scenario is that it misses an opportunity, a short-term rally. During a market correction, strategies like strategic asset allocation continue to be exposed to further capital losses with little plan to combat them or move portfolios to safety. Think of a group of people outside your family you care deeply about, people you're committed to and would do anything for. That is the 401k investor to me. I deeply wish for my investment strategies to help 401k investors navigate difficult market conditions. When I say 401k investor, it could just as easily be synonymous with a 403b investor, which is a 401k within a school district or a hospital, or a 457 plan, which is the 401k equivalent in a nonprofit or a governmental entity. 401k investors, like index investors, have had tailwinds behind them that have dramatically increased account values during the bull market. But the same conditions that led to their success may drive their undoing in a declining market. The two biggest bull markets have happened during our lifetimes, 1987 to 2000 and then 2009 to present. Because stocks and bonds have been in bull markets for so long, the investment option menus of 401k plans have gravitated almost exclusively to stocks and bonds. Now today, with 401k assets almost exclusively invested in the stock market bubble and the bond market bubble, it's a very dangerous situation for investors who will not take action. Do you have things in your life that you wish you could go back and change? I know I do. This is one of those moments, staring you in the face. We know the stock market rally is going to end, and there's still time to save your 401k. For those that went through these periods, they may wish they took action before experiencing these terrible declines. How would you feel to have built your 401k portfolio over a lifetime up to, say, $500,000, only to see it lose in a matter of 3 months $100,000, or within a year see it decline to $300,000? We all have our loss thresholds where deep regret would set in, as well as family hardship. 401k investors are boxed into plans loaded with bubble assets and vulnerable to US dollar declines, making most 401k accounts digital kill boxes today. But there are ways to sidestep the danger for investors willing to investigate all options and take decisive action that maybe no one else at their company may take. Our investment strategies, combined with some 401k plan features, offers 401k investors an opportunity of a lifetime. With the narrow menu of choices in most 401k investor plans, we can use some but not all of the winner strategy tenets. But if your 401k is eligible for any of these features, then opportunities get unlocked. Here are some 401k features to explore, with the whole point being to unlock far more investment choices than are typically available in a 30 to 40 choice 401k core lineup. The other features literally allow you to move all or a portion of your 401k money out of it and get it out of the danger, out of the digital kill box. Of course, if you're eligible to do a rollover from your 401k to an IRA, then that's the simplest way to get access to far more investment choices than the average 401k lineup. Let's say that you're still employed at the employer where your 401k account is, and you're not eligible to do an IRA rollover. There are some other features that may be available within your 401k plan. And the reason is to give you access to more options than just the stocks, bonds, and cash options in your account. In a Fidelity 401k and 403b plan, they have a feature with larger plans generally called Brokerage Link. This attaches a brokerage account which gives you access to thousands of investment choices rather than just the 30 to 40 choices generally available in a 401k core option. These brokerage accounts are not just offered by Fidelity, they're offered by many 401k providers out there. An in-service rollover is a feature allowed currently to employed 401k account holders to roll over a portion or all of their 401k balance to an IRA, even if they are not separated from service. It depends on the plan features, but in one example, 401k account holders who are older than 59 and a half or have after-tax contributions may be eligible for an in-service rollover. Non-prototype plans could be an option for 401ks, profit sharing plans, pension plans with a smaller number of participants. Non-prototype again provides a brokerage account available for the 401k account holder instead of just being limited to its core options. Again, we're pursuing all these options in a bear market because a 401k could easily become a digital kill box if the stock market bubble pops, if the bond market bubble pops, or the US dollar declines significantly. So if all these features don't apply and aren't available to you as a 401k investor, someone can look at a 401k loan as a last resort option to get money out of the digital kill box. Taxes can be the impediment that prevents investors from making the decision that will keep the most money in their pocket at the end of the day. Taxes become the primary factor, keeping investors from taking actions and keeping investors in a subpar investment choice. I see this all the time, so I want to discuss some real-life examples that explain when selling can lead to more money in your pocket after taxes. Not wanting to pay the capital gains tax is a major reason investors don't take action, and it makes them vulnerable during a bear market, letting the tax tail wag the investment dog. The investment decision is generally more important than the tax decision because more dollars are at stake. Let's look at an example. Stocks, even the leaders, correct massively during bear markets. Look at Amazon and Apple in 2008. Amazon down 44%, Apple down 56%. In scenario 1, a $50,000 stock declines 20%, declining in value to $40,000. In scenario 2, the investor takes action and sells the position, incurring 15% capital gains taxes. 15% capital gains tax is a smaller amount than a 20% decline in the stock. When you pay taxes, you're just paying on the gain. When a 20% decline happens, it's on the full amount. So in scenario 2, paying the taxes leaves the investor with more money afterwards than allowing the stock to be exposed to a bear market and losing 20%. Here's a sample portfolio I see all the time with large amount of assets caged up at bank trust accounts. I say caged up because these assets have been at the bank for decades with little changes to the portfolio that are generally former blue chip stocks because these stocks may have been leaders and had their day, but that was decades ago. They stay in the portfolio because the bank has little incentive to recommend selling and encouraging large capital gains taxes that have built up over the decades. With the large capital gains, it reinforces the idea of taking no action. So what's wrong with this? This is a brand name list of stocks that made money over time and avoided paying taxes. The first issue is that most of these stocks are laggards now. There's been an opportunity cost in holding laggards and lower returns versus updating the portfolio periodically with leaders. I've heard so many bank account holders say they have paper stocks in their portfolio when they would prefer to have some Amazon or Apple instead. Another huge problem today is that these portfolios create permanent stock allocations and are not equipped to protect investors during a bear market. Let's look at AT&T in another example. Currently, the AT&T stock price is around $37, and that is lower than the AT&T stock price 17 years ago. At the beginning of the century, in year 2000, it started at $42. Let's look at when it would make sense to sell AT&T stock, pay the taxes, and hopefully put the proceeds into something that performs better. Say an investor or trust is paying the highest capital gains tax rate at 23.8%. If you sold AT&T stock with $40,000 of capital gains, that means there's about $100,480 left afterwards. In this scenario, the break-even price is $33.93. If AT&T stock stays below $33 $8.93, then it would have been better to sell the stock and pay the taxes. I bring up this scenario because it's so common with bank trust accounts or large Wall Street firms that'll just sit there like the sample portfolio does, and nothing happens before and during a bear market, when something better could happen for these investors that could benefit their families for generations to come. Another reason I bring it up is because people are smart. Their intuition tells them that the bank trust department is behind the times and not always looking after them. They keep the assets there because they're busy and they don't feel they have a better alternative. I feel my firm offers these investors a much better service, could save their portfolio massively in the next cycle, and investors still get the big trusted brand name because we work with Fidelity Investments. Assets are sometimes stuck in a bank trust department because the bank is written into the trust as a trustee. This is an old school and outdated way of operating. Families in this situation have options here. It has never been more important to explore other options now instead of just letting account values plummet. We can help families find a better solution when they have investment assets at the bank. Here are the next steps to learn more and take action. Don't be like most investors who will delay action and take 10%, 20%, 30% losses before they admit they have a problem. If you'd like to sign up for a brief introductory call to discuss your situation, please email me or call me at 313-884-5961. You're not committing yourself to anything. I'm structured the way I am for deliberate reasons. I want to serve a small group of people, so I only want to start working with someone if it's a great fit for you and it's a great fit for me. On my end, it's important that people I work with are grounded, see this as a partnership and not an adversarial situation. They are kind and have realistic expectations. We get into all that in the call. If you're able to email me your investment statements ahead of time, it is helpful but not mandatory. Please screenshot or attach your bank or investment account statements. That could be stock and bond brokerage accounts, IRA accounts, 401k or annuity accounts. That could be a pension plan or a foundation account. That could be a bank account you have sitting on the sidelines. It's been a 20-year journey to be ready for this moment. I feel this is my time to navigate a small group of investors through difficult market conditions and seize an opportunity. The strategy and information I have to offer I feel is very important for investors to be exposed to. I see myself as a conduit bringing the thinking of successful investors and their strategies to everyday investors, high net worth investors and institutional investors like pension plans and charitable foundations. I also see myself as an advocate or a trusted friend who is telling it to you like it is and steering investors away from damaging conventional investment wisdom. There are many good people in my industry who would like to be able to have these conversations with investors, but they are restricted by compliance departments, investment committees, and big company policies from delivering this meaningful information to investors. So I'm structured to deliver independent information to you. The easiest way for you to stay updated is to go to pratherinv.com and click one of the red buttons to join our email updates. You will not be bombarded with emails. Also, please subscribe to our YouTube channel for regular content to protect your family.